We're now going to come down to the part of the program and about the business that most people don't like talking about because it involves numbers and numbers that they occasionally have to share. The business of fashion. What does it take for a company to be interesting for investors? What does it take to grow your brand, to grow your business, to where people are willing to shower money at you? We have a great panel that's going to be talking about just that. And I'd like to call on stage Sanjay Vakharia, Director and CEO at Spykar. Nikhil Mohta, Director Private Equity at ICICI Venture. Manu Indrayan, Co-founder and CEO 612 League. Sneha Jain from Manyavar. And to lead the discussion and moderate the session, Waqar Naqvi, Business Director, Wazir Advisors.
Good morning, ladies and gentlemen. Shall we start? So we have a very eminent and illustrious panel here. Sitting with us is Manu, who is a co-founder of 612 Ivy League. Sneha, who looks after the investments from Kedara into Manyavar. We have Spykar. We have from the investors side, Nikhil from ICICI Securities. The topic that we are going to, the points that we're going to discuss today are how do investors look at investing in the apparel space, and what are the companies looking at from investors? How do they look at making the metrics right so that the investors are more positive about investing in those companies, and how do they grow their businesses together? What is the collaboration between the investors and the companies that they've invested into? So I start with Nikhil on what's his view and ICICI's view on investment in the apparel space. I mean, there have been a couple of investments in the last couple of years. Some of them have been pretty good. Some of them have not been as expected. What's the view that investors have for the sector? And are you really looking forward to investing more and more into the physical space? I know there's been a lot of investments in the online space and more and larger investments. But what about the offline space? And how do you see this play between online, offline from an investor's perspective?
Yeah, thank you, Bhag. So as ICICI Venture, it's a space we've always liked. It's a space we've always sort of interacted with. To add credibility to that, we recently invested in Go Colors, which is in the last 3 months or so. So I think apparels, fashion, the broader fashion space, if I can use the term, is something I think which is something we, as investors, we're very positive about. There are a lot of sort of strong sort of underlying trends in the space from a macro perspective, whether it's sort of the overall growth story in terms of income levels going up, per capita going up, into the more retail space coming out, in terms of brand differentiation starting to come out and play on their own. I think it's a space we quite like. I think we also believe that from an Indian perspective, there are very few brands of size and scale. And that is something we think should change and will need to change over the next few years. And as an investor, we are more than happy to sort of play our part in sort of providing the capital to the right entrepreneurs and playing that change. So I think from an investor perspective, what we like to see is typically we want to see businesses which have a long-term sort of sustainable story, long-term franchise value. We are a rather old world private equity house. We are not guys who believe that businesses can double or triple overnight. We are happy to see more steady growth trajectories, but we like to see businesses which are building from a long-term perspective. So in terms of the kind of brands that you're trying to build, the kind of product segments you're playing in, the kind of management team and business processes that you're setting, right? The kind of channel relationships and the channel partners that you're sort of signing up. So the idea is really to see if business from a longer term perspective and see, can you build this as a brand, as a story over the next 10, 15, 20 years? That's what makes it exciting for us.
So is it more top line driven or is it more bottom line driven? I think that's the session topic. Is investment more function of the waistline or top line, or more a hemline driven thing?
I think it's neither. I think it has to be both, right? If it's pure top line, I think what we don't like is, we like to see businesses which are sustainable. For sustainability, growth is a must. Status quo is not an option in the country as we stand today. If you're in a status quo mode, someone else will come and eat your lunch. That could be an international brand, that could be a domestic brand, whoever it is. So status quo is not an option. growth is a must, but growth without bottom line, without sort of healthy growth, is not something we are too excited about. So for us, both are important.
Sure. So Manu, or rather, Sneha, you raised capital most recently. What has been your experience? What were the metrics that Kedara was looking at when they were investing in Manyavar? I'm sure one of the metrics was it's a sustainable story. It's a unique product category where there are not many players besides you. What was the hypothesis and what was the key elements of investment from Kedara into Manyavar?
So, good morning, everybody. I think the first and the most important thing is if the business has a vision. And you know, where is it that the business intends to go and where is it that the stakeholders want to take the business? I think that's the most important thing. If they're clear about setting up something which, like he said, is sustainable and you know, which can generate long-term value. But I think also what is more important is what are the things that are already set in place. That becomes very important. So I think a focus on systems and processes becomes very important. That you know how your merchandise is moving in the fashion and apparel space, in the retail space. So how well your merchandise moves, how well do you know your customers, you know, their tastes and preferences. So I think if you get those basics right and your customer focus and your customer centricity right, you're in a place where investors can look at you to come on board and work with you. I think also with Kedara, what is very important for them, so how they work is very unique. You know, whenever they want to invest in a business, they look at what are the things they should change in a business so that it goes from point A to point D, okay? But what they also do is they make a list of things that you will not change in a business so that it goes from point A to point D. So they have a very good listing out system of what are the unique USPs of the brand and you know what is it that should not change. So in case of Manyavar, it was definitely the value system that we brought with us. So the whole, you know, we're very rooted to our Indian values and Bharatiyata is something that we always talk about. That is something they did not want to change at any cost. So that's the ethos that the brand carried with it, which was very important for them.
And post the investments, how have the two of you worked together, Kedara on one side and Manyavar, to grow the strengths and to kind of optimize whatever best could be on the other operation side?
Really exciting. I mean, the last 1 year since they've come on board has been just so much learning for us. You know, we still are a small company, 1,000 crore small company based out of Calcutta, which is, I think, very few things happen in Calcutta, as all of you would agree. And, you know, then they come in and, you know, they just tell us how to do things better. And it's so exciting for us because there are so many new things we're seeing. So just an example of how we did not use, we had our own in-house analytics teams, you know. We did a lot of analytics, but they were all on the merchandise side. They came in and they said, hey, why not just get someone and put customer analytics into place? And we did so much work on it. And we just see so much is happening in that space in the country and in the world, and it's so exciting. So, you know, there are many examples of this sort where they're just showing us new things and great things which are happening in the world, which we can do. And that's what's exciting for us.
Sure. And on that note, when we talk to a lot of our clients and we talk about investments from the funds, one of the things that we kind of hear from a lot of people is that we don't need money. We have a lot of internal accruals, and one of the things that we tell some of our clients is that investors typically just don't bring funds. They bring in a whole lot of ecosystem. They bring in a whole lot of best practices, which are anyway very, very essential for the overall growth of the company. So Sanjay and Manu, would you like to kind of comment on that? Because both of you have looked at that space, and what are the things that investors bring in beyond just money?
I think I'll just bring in an added perspective because we've just heard, you know, the Manyavar at whatever stage of business that they were in and what is it that investors brought in would be very different than what stage we were in when, you know. So let's look at our story is more, you know, startup from scratch story. So the partnership at this level with the investors is from a different perspective. It's essentially growth capital to just help purely, let the business grow. Now, I would just bring in, before I come to the point that what is it that, they actually bring to the table. This whole concept of investors and apparel businesses coming together is basically to, of course, help create value and, really help businesses achieve their potential. And in India, the stage at which we are in, there are no, two ways about it, that branded apparel business is at a stage where it's at a very, high growth stage, and there is a lot of potential for many brands in many spaces to kind of really create something very big here. Having said that, I think the investors primarily aim to create value within a certain specified period of time, which is permitted by the mandate of their fund, etc. So we need to understand at what stage is the business and what is the specific requirement of the business for that stage. And for that, I think, in my experience, we could kind of classify this whole journey of a apparel branded business into, 3 stages. The first stage is what I would call the first threshold is, something like a below 100 or 100 crore stage where a business actually establishes itself and, kind of establishes the product line, consumer segment, and, establishes the primary selling channels, which are essential to actually help build up that whole, branded apparel business. The second stage is what I would call about 100 to 300 stage. And the third stage is, 300 to 1,000, and then, of course, 1,000 plus. So I think Manyavar has already reached that stage. So they are looking at a different, perspective. Initially, what is required is that when businesses start, when you are in a 0 to 100 stage, and if that stage when you raise capital, you just, the main thing which investors bring in is they try and bring a structure to the business. Because it's, because having set out to do something, having set out to create a brand, the main thing they do is just to make sure that you remain organized. Since it is an apparel business, very SKU-based management, etc., that you have your, MIS systems in place, etc., and then of also strategizing about what are the right channels, because at that stage you're still deciding on what are the right channels for you to actually reach out to your end consumer. How are you, in fact, even defining your whole space? So those are very formative years. And it's only in the second stage where the challenges become different. And then I would say the investors at that stage will bring in something different, which is basically that having established yourself as a kind of a reasonably known apparel brand, then it is about growth. How do you manage growth? So I think there are different stages, and of course we can, discuss each stage in detail, but we need to just understand that.
From Spykar's perspective, probably this is the second set of investors that we are working with right now. And I feel, it all goes back to a very basic tenet, It's the primary diligence that one needs to do is on people versus anything else. Because I feel if you don't have the right set of people aligning, then however good processes or however great the markets are, they are not going to really work for either, That's for me, I think, whether you are on the investor side or whether you are on the brand side, I think the primary alignment has to be on whether we are fine with each other or not. For an investor, it's very important to know with whom he's working, because so the kind of business that we are in, it's not binary for sure. A lot of things is on gut. Whatever level of analytics you employ, they will only be able to give you historical data. Okay, there are people who are trying to do forecasting, but then again, I am a very strong believer that if you use analytics to get into forecasting, then you'll be just creating clones. And this whole essence of fashion and creativity and uniqueness will just probably not exist, or it won't survive, and it will not give any brand an edge in the market. So I genuinely feel that the set of people finally are very, very critical in this kind of space, where it's not 1 + 1 = 2 as binary as that. So having done that, then both the parties really need to understand what the goals are. And here, I think it's more important for the brand owner to understand what the goals are, because he's in this whole business for good, whereas the investor has a definite period that he wants to be in the business. So if you don't align your goals there, the speeds are probably which are going to create the issues between you two. So the investor wants to move probably at a speed which allows him to move out at 5 years. You know there are issues in the market. So if the last 3-4 years, if you look at it, nothing has been constant for a while. You know, it's been really disruptive. And I really don't, I hope that this year is not going to be as disruptive as the previous year, but then we always have something else happening in the next year. So from that perspective, the period at which we both are going to be aligned needs to be kind of very sure. And for any brand owner, I would say that you need to really look at people who are a little long-term in the horizon, because you know, the whole euphoria of people making tons and tons of money through valuation, I think those are days which are gone. So it's really hard work out there. If you do it well, there is money to be made, but the money to be made is not in that quantum that which people were looking at a few years back. So tempering of what expectations are, tempering of how do you want to move ahead, all these things I feel are going to be very critical for either parties, you know, because, and I genuinely feel that as a brand, you need to take private equity money only when you're doing well, because that's the time when it is a relationship of equals. The minute the brand gets into a difficult zone, then everything, though the investor feels is moving his way, is actually not moving his way. So I feel it's the timing which matters a lot. I think the overall goals that both the parties have, which matter a lot, and the connect that you have with people. So for me, it's paramount is people. It's nothing else. Everything else can be set up. I mean, I can give you an example of Spykar. Same set of people with 2 investors. Today we are probably amongst the top 3 in profitability. And the earlier investor really couldn't manage anything. So what has changed at our end? Nothing as far as people and operations are concerned. It's probably the alignment of goals and ambitions of 2 sets of investors which were not right. So I guess that's where it is.
I think you touched a very important point of alignment between the investor and the management of the company. Nikhil, would you want to throw some light on this? Because that's very critical to creative wealth for both stakeholders. I think if there is this discord between, or for want of a better term, this disalignment between the investors and the companies, things may or may not, and we've seen this happening in the apparel space in many of the investments.
I think fundamentally the point Sanjay made, that disalignment will always be there to some extent, because as an entrepreneur, you're in this journey for 20, 30, and in the Indian context, maybe for a few generations, right? But as an investor, you're coming in for a 4, 5, 6 year period. Having said that, putting that in the background, putting that in the context, it's very, very important upfront to sort of be clear as to what is doable, what is not, right? As an investor, it is very important for me to know that, look, this is the person I'm partnering. It's not just the business that I'm partnering, it's the person that I'm partnering. And am I, as an investor, willing and able to sort of work with this person for the next 4, 5, 6 years? Recognizing fully well that even forget the last 3, 4 years of disruptions, even in a healthy growing economy, when you're trying to grow a business 15 to 25% a year, there will be years things will go as per plan, there will be years things will not go as per plan. Are both of you sort of able to understand and acknowledge that? Are you able to build in that margin of error in the business plan? Are you able to sort of believe and trust each other that, look, both of you are doing the right things for the business? As long as that trust is there, as long as you know the two of you have a working style which sort of matches, where you're complementing each other. As an investor, I'm not trying to tell you what kind of products to put in the store, where to source your products from, what the design palette should look like, right? Whereas at the same time, if there are issues around financing, issues around governance, issues around strategy where I possibly can add more value, right? The management doesn't sort of say that, look, what does this guy know? I think that mutual respect, that mutual trust is very, very important. It's important for both management and investor to know what their roles genuinely are, right? As an investor, I am not interested in being CEO of the company. If that's what I wanted to do, I wouldn't be sitting where I am. I think these are very, very important sort of things for people to understand and acknowledge and accept. it's when you sort of go down the path of raising capital, I agree with Sanjay, it's always better to do it when business is looking good, things are looking up, because then you're sort of in a positive frame of reference, you're sort of doing a deal of equals. But at the same time, when you do that, you have to also recognize that the investor is also there for making money out of this whole process. And invariably, it's not the investor's own money. The investor is also in a fiduciary duty because he or she has raised capital from a variety of institutions across the world or in India, right? So they also have a fiduciary responsibility. So when you set up the whole business plan, when you set up the whole investment conversation, as management, you also need to have the same perspective saying what is real, what is unreal. If I push for a higher valuation today on the basis of an unreal business plan, that also does lead to breakdown, because moment you realize things are not going as per plan, that look, despite things going 15% a year, if I underwrote a 25% growth story in valuation and it's a 15% growth story, there will be a mismatch. So I think it's an onus on every side. As an investor, if I sort of just take a management business plan and sort of believe this is fine and underwrite it, that's my folly. But even as management, if you aggressively push for a business plan on the sake of today's valuation, that is a challenge. I think as management, as much as we say that, look, since they are long-term in nature, they also need to sort of take the perspective of value creation from a longer-term perspective, and therefore build a business plan in a manner which adds to the business from a 10, 15, 20-year perspective. Most importantly, I think the point Sanjay made about the chemistry between the people on two sides, I think that cannot be overstated. Right? At the end of the day, no matter who the institutions are, you're dealing with people on both sides. And if those people do not have the right chemistry, do not have the right understanding and a right manner of working with each other, do not trust and respect each other, believe that if I'm a minority investor in a company and I believe that my majority partner is not doing things which are in the right interest of the company, there will always be a dispute. But if I believe he's taking decisions in the right interest of the company, some decisions may go wrong, and that's fine. What is good for the 80% has to be good for the 20%. As long as both of us understand and believe and have comfort in it, it works fine. Moment as an investor or as a management, I start believing that my 80 has a different value or the 20 has a different value, right? That's when things start to sort of break down.
Manu, any views on this?
No, very much. I think I think it should be looked at as a some kind of a marriage, and you need to live together, right? And you need to be broadly in sync with each other of how you want to lead your life. Otherwise, it doesn't work, because if you want to go on different tangents, and that's something which can be laid out right in the beginning, because when you're drawing up the business plan, when you're pre-investment, because there are a number of, it's not like an overnight decision which an investor or a company takes. And it has to be a mutual decision, mind you. I mean, it is very well to see that, someone who has shown interest in the company wants to invest. But I think it is equally important for the companies also to assess whether there could be a mutually fruitful partnership, because it's not only about the money. It is, of course, the money is primarily, it is required, especially if you're in a formative stage. But then you also need to work together. You should have common goals, at least till the tenure of the fund that, is there. And then it should also be, as everyone said, aligned to your long-term vision. Maybe at that point of time, the thing which founders or company owners you need to do is that they need to be very flexible in hearing out, listening to ideas, maybe strategies, because it's not that whatever solution or whatever vision you have is the final vision and that is just the right thing. Maybe there are a number of times, obviously investors with their kind of experience and their kind of interactions with other people in the industry can give you a lot of perspective. You have to be open. There is no question of ego there. It is about taking joint decisions as far as key strategy decisions are concerned. To that extent, you need to be very, very open and flexible. Having said that, assess, make yourself comfortable. And I think one of the investors, when we were interacting in the first round, said, and that's the key, he says, Manu, if you could, if you feel comfortable picking up the phone at 10 o'clock at night and telling me if there is something which has gone wrong or right, that is the time when, you should take a call. And I think that is the key, that, if you have that relationship where you do not, treat them as outsiders. They are part of your system. They are not there for day-to-day management. They're not there for day-to-day operations. They're not telling you, as you said, that you buy from X and, sell to Z. But then, as a business, eventually you are both in it to create certain value for the shareholders. And to that extent, I think there needs to be, some kind of very, very heavy comfort with each other.
So my last question, and then we wrap up the session, to Nikhil. A lot of the funds that we meet also specify that they want to invest in only a certain size of the company. And given the structure of the market, there are not very many companies beyond 500 crores. There are very, very few beyond 1,000 crores. Is that something very critical? How do you look at it?
As ICICI Venture, we're very happy to work with companies which are sub 500 crores. We don't have any such. But I think the broader point you're making is right. There are different investors for different stages of a business's evolution. The point Manu made right up front. When you're a startup, you're looking for a different kind of investor, a different kind of support. When you're growing from 100 to 300 to 500, you're looking at a very different kind of investor, different kind of support. And beyond that, obviously, it becomes a very different ballgame. I think the bigger challenge is the fact that a lot of capital which is coming into the market, at least in the last few years, is capital which wants to see very rapid returns, right? Thanks to the e-commerce story, people have sort of gotten used to this concept of 100% year-on-year growth and stuff like that. Unfortunately, that doesn't happen in the real world, and certainly not in a sustainable manner. As investors, as an investment house, I think we are very, very cognizant of it, which is why the first point I made was we look at businesses which are sustainable in the long run. We are not guys as an investor who like to back businesses which needs 5 rounds of capital raise just to survive, right? We are happy to write a larger check today. We are happy to put more money in the business, but we want to build a business plan in a manner that sustains. At the end of the day, in India, let's be honest, most of us back promoters and management teams. Most investments in this space and otherwise are minority deals still, right? You want that management team, that promoter to have enough skin in the game over a longer term period for him or her to be excited about doing that business. You don't want him or her to be on the road every year trying to raise capital, right? You want them to focus on building the business in a sustainable manner. Then if you're a 100 crore business or a 300 crore business or a 500 crore business, there are different investors who look at different ticket sizes, right? As ICICI Venture, we look at ticket sizes of $20 million and more, right? 120, 130 crores. And that's fine, that works for us. So we look at a businesses of a certain size. If someone is smaller in size and scale, they look for sort of investors who sort of maybe do the 50, 60, 70 crore kind of deals. And for businesses which are much larger, there are obviously much larger investors as well. So I think the market is fairly tiered. More than the capital of it, I think, echoing Manu's earlier point, I think as a company, you should be clear why are you raising capital and why are you getting in an investor. If it's only for the money, then you're better off probably taking bank debt or someone who's probably going to sit 10,000 miles away, come twice a year and sort of not ask you too many questions. But hopefully, as investors, we are able to bring some value to the business, right? By being collaborative, by being partners, in which case you obviously first sort of take a view on saying who's the right investor for you, both as an institution and as an individual. And with that individual or other institution, then you negotiate as hard as you can. You get the best of the terms you can. Challenge which happens is in the current sort of framework, how deals get run. You sort of invite a bunch of bids, you then sort of see who are the highest bids and then sort of try and see, okay, now within these top 3 bids, who's the guy who's least not palatable to me, right? It probably just has to be the other way around, right? You first sort of say, who are the 1 or 2 or 3 guys I'm most comfortable with? To Manu's point, who's the guy I can pick up a phone at 10 in the night and convey bad news, right? And then sort of say, okay, now I know this is the person I want to deal with. Now let me negotiate as hard as I can, and that's fine.
So the last question to the companies which have investments. What is your suggestion to the delegates sitting out here and to the larger industry who is trying to raise funds? What should be the top 2 things, and maybe a minute each at best? What are the top 3 things they should look at, and what should they expect?
I think the first thing I would say is that set out a very, very realistic business plan and set the level of expectations very clear on the table. Because normally if we tend to create unreasonable expectations from the business is when it starts boomeranging back on you. I think very honest assessment of the business plan, which has to be backed by real research and understanding at your end as well. Because eventually the investors buys into that business plan. They make their own assessment, but I think that's where I think I would say the top the most importantly, may be very sure of what you are setting out to do and be very honest to what you are setting out to do. I think that's the most important key.
I think what businesses need to focus on is what they want to continue doing themselves and what they need the investors' advice on. I think if they can create that divide, and I think they can best collaborate only when that happens, when they know their key strengths and they marry into an investment firm which come with another set of key strengths and they can just complement each other. I think that if that analysis is made, I think it can be the best collaboration that can come on board.
So my advice is that the promoters and the founders, they know the business much, much better than the investors. And that is a belief that one should always have. Because if that belief is shaken, then everybody's monies are going down the drain. So whoever is wanting to get any monies invested in the company, I feel primary, one has to have a kind of sense of who's going to be partnering you, who's going to sit on the board with you, whether he has enough experience on ground, because the business on Excel and business actually on ground is very different. So all these few diligences, if you can do on people, again, I'm coming back to people, I'm sorry, but I feel it all finally revolves around who's partnering you, who's with you, whether they really are appreciative of what markets we are in, the challenges that are there in front of us. So if all these things are taken care, then I'm sure you'll have a very, very good journey. And having said all these things, it's very important to have enough money in the business, because business will also crumble if there is not enough capital. So a brilliant idea, a brilliant opportunity, but not enough money at the right time. All these are issues which probably will take the whole fun out of the whole business. So I think that's what.
Well, thank you, gentlemen, for the very, very valuable inputs, and I'm sure the audience would have gained a lot from your experience. Thank you so much.
Thank you.